macro currency signals.
There are moments in history when a market moves quietly beneath the surface, unnoticed by the majority. While the foundations of pricing power begin to shift, we are entering one of those moments now. Not because of a headline, not because of a single dramatic spike, but because the structure of the silver market is changing in ways that very few participants truly understand. The question is simple, but the implications are enormous. What happens if the United States decides to stockpile silver again? Not as a symbolic gesture, not as a token purchase, but in size. 50 million ounces, 100 million ounces, perhaps more. If this makes sense to you, subscribe and turn on notifications. In times like this, getting information early can make a real difference. Comment below where you're watching from and what time it is there. This isn't just happening in one country, it's global. Now, let's get back to what's quietly changing beneath the surface. To understand why this matters, we must begin with a fundamental truth about markets. Markets move at the margin. They do not require the entire supply chain to vanish overnight. They do not require warehouses to be empty. They only require incremental demand to exceed available supply at the edge. That edge is where price is discovered. That edge is where control shifts. Silver is not just another commodity. It is a monetary metal with a 5000-year history, but it is also a critical industrial input embedded in the modern economy. Today, roughly 60 to 65% of silver demand comes from industrial applications, solar panels, electronics, advanced circuitry, electric vehicles, medical equipment, AI infrastructure. This is not speculative demand, it is structural consumption. It is physical metal leaving the system. At the same time, the silver market has been running structural deficits for years. Annual mine supply and recycling have not fully satisfied annual demand. In recent years, those deficits have averaged close to 200 million ounces, and yet price has not reflected that scarcity in a proportional way. Why? Because the paper market has historically absorbed the strain. For decades, futures contracts, unallocated accounts, and exchange inventories have functioned as a buffer. Physical deficits were met by drawing down above-ground stocks. Metal sitting in commercial bar form, metal held within exchange systems, metal that was available for delivery. Slowly, quietly, that inventory was drained. Between 1980 and the mid-2000s, the market endured roughly 15 consecutive years of structural deficits, averaging around 100 million ounces per year. That is 1.5 billion ounces of silver that disappeared from above-ground stockpiles to meet demand. And during much of that period, the price barely moved. Why? Because there was enough inventory to satisfy buyers at the posted price. The last car on the lot was sold, demand was technically met, the price did not need to rise to ration supply because supply, though shrinking, was still available. But here is the critical difference between then and now. Inventories are not what they once were. The cushion is thinner, the margin is tighter. Now imagine adding a new source of sustained demand into that equation. Not speculative leverage, not hot money, not short-term momentum, but a sovereign-level strategic accumulation program. In the mid-1980s, the United States strategic silver stockpile stood at approximately 139 million ounces. Over time, that stockpile was depleted, much of it used to support coinage programs. Once exhausted, the system had to turn to the open market to secure metal. There is currently no public confirmation of a new stockpile initiative, but the strategic logic is increasingly difficult to ignore. Silver has been formally recognized as a critical mineral. It is indispensable to energy infrastructure, defense electronics, grid modernization, and emerging technologies. In a world that is fragmenting geopolitically, critical materials become strategic assets. If even a fraction of the former stockpile were rebuilt, say 50 million ounces, that alone would represent roughly 1/4 of a single year's structural deficit. If 100 million ounces were accumulated, that would represent half. The timing matters more than the total. If 100 million ounces were accumulated over 10 years, the impact might be modest. 10 million ounces per year would add incremental pressure, but it would likely be absorbed gradually. However, if 50 million ounces per year were accumulated over 2 years, that is a very different scenario. That is 100 million ounces pulled from the market in a compressed time frame. Again, markets move at the margin. The more physical metal that is removed from available circulation, the more strain is placed on the exchange system. And the more strain that builds, the more the balance of price discovery begins to tilt toward the physical side. This brings us to a deeper issue, the battle between paper and physical. For decades, the futures markets have exerted significant influence over price. Contracts representing large quantities of silver trade in volumes that far exceed daily physical production. Most of those contracts never result in delivery. They are cash settled, rolled over, or offset. As long as confidence in that system remains intact, price can be influenced by leveraged positioning. But when physical demand intensifies, when industrial users, sovereign entities, and long-term allocators compete for real metal paper claims begin to face constraints. There was a glimpse of this dynamic during the recent parabolic move in silver. In 2025, silver surged dramatically, rising more than 140% in a relatively short period. The speed of the ascent attracted momentum traders and leveraged participants. And as history has shown repeatedly, the faster a market rises, the sharper the correction that follows. When silver corrected more than 30% in late January, many declared at the end, the biggest crash since 1980, some claimed. But context matters. In 1980, silver experienced a collapse of more than 50% in a single episode, falling from over $20 to near $10 in a matter of days. That crash marked the end of a bull market driven primarily by concentrated speculative leverage. Once that leverage was unwound, the foundation was gone. Prices drifted lower for years, eventually spending nearly 2 decades in a wide sideways range. Today is structurally different. In 1980, industrial demand represented roughly 30% of total usage. Today it is roughly double that. Annual mine supply in 1980 was around 500 million ounces. Today it is closer to 1 billion ounces. The market is larger, deeper, and more globally integrated. Most importantly, the driver is not a handful of leveraged participants attempting to corner supply. The driver is systemic industrial consumption. Solar panels require silver paste. Electric vehicles require silver in circuitry and battery management systems. Data centers require silver in advanced connectors and cooling systems. Medical devices require silver for antimicrobial properties. Artificial intelligence hardware requires high conductivity components. This demand is not optional. It is embedded in production. That does not mean price will move in a straight line. It never does. Parabolic advances invite corrections. Corrections shake out latecomers. Bull markets are ruthless in eliminating weak hands. But a violent correction does not invalidate a structural bull market. It often strengthens it by removing leverage and resetting sentiment. Now consider the additional layer, direct mine offtake agreements. Increasingly, industrial users are bypassing exchanges entirely. Instead of purchasing through intermediaries after metal reaches exchange warehouses, they secure supply directly from producers. Concentrate moves from mine to refiner to manufacturer without ever appearing on exchange inventories. When metal never touches the shelf, it never contributes to visible supply. It never becomes part of the registered category. It never bolsters confidence in paper claims. This quiet disintermediation matters. It tightens the float. If sovereign stockpiling were layered on top of industrial offtake agreements, the visible supply available to exchanges could shrink more rapidly than most models anticipate. And then there is the retirement capital angle. For the first time in decades, institutional and retirement accounts are gaining increased flexibility to allocate to precious metals. Defined benefit plans, corporate retirement programs, systematic monthly contributions. These are not speculative flows. They are automatic, persistent compounding flows. Even a small percentage allocation across large retirement pools would represent steady physical demand, month after month, year after year. That demand does not panic sell on corrections. It accumulates. Now layer the possibilities together. Industrial demand running at 60-65% of total usage. Annual structural deficits near 200 million ounces. Direct mine-to-manufacture offtake bypassing exchanges. Potential sovereign stockpiling of 50-100 million ounces. Retirement capital gradually allocating to physical metal. Individually, each factor exerts pressure. Together they reshape the landscape. The key point is not that silver will move parabolically tomorrow. The key point is that the control of price discovery may gradually migrate from leveraged paper markets to constrained physical markets. In the past, deficits were absorbed by drawing down massive above-ground inventories. Today, those inventories are thinner, the buffer is smaller, the system is more sensitive. If a sovereign buyer enters the market decisively, it sends a signal, and other nation-states will notice. If silver is deemed strategic for one, it becomes strategic for others. Strategic competition for physical metal introduces a geopolitical layer that did not dominate prior cycles. Markets are adaptive, participants adjust, but physical scarcity cannot be printed. The real battle is not bulls versus bears, it is paper versus physical, and every incremental ounce removed from circulation shifts the balance. The question is no longer whether silver is volatile. It always has been. The question is whether the underlying structural forces now in motion are stronger than the corrective waves that temporarily obscure them. If the United States were to announce a formal program to accumulate 50 to 100 million ounces over a compressed time frame, the margin would tighten. If that accumulation coincided with sustained industrial deficits and growing retirement allocation, the pressure would compound. We are not talking about theory, we are talking about flows. Physical flows, tons and ounces leaving the system. And when the marginal ounce becomes difficult to source, price does not ask permission. It adjusts. The silence around this possibility does not make it insignificant. In fact, it makes it more powerful, because markets rarely price what they do not yet see. The strategic stockpile question is not about nostalgia. It is about preparedness. It is about resilience. It is about control over critical inputs in a world that is becoming less stable. 50 million ounces could matter. 100 million ounces could matter even more. Not because they represent the entirety of supply, but because they represent incremental demand at the edge. And at the edge is where markets break. That is where price discovery shifts. That is where paper promises confront physical reality. And that is why the possibility of renewed stockpiling is not a footnote. It is a potential inflection point. Because once you understand that silver is running structural deficits, that industrial demand now dominates total usage, and that visible inventories are thinner than they were in past cycles, the next logical question becomes this: what happens if pressure builds slowly instead of explosively? Most investors are conditioned to look for parabolic moves. They expect fireworks, they expect overnight doubling, they expect the kind of vertical spike that makes headlines and draws in crowds. But parabolic moves are unstable by nature. They attract leverage, they invite excess, and excess always cleans itself out violently. A slow structural grind higher is far more powerful. When price rises gradually, month after month, year after year, driven not by speculation but by persistent physical absorption, something subtle happens. The weak hands never get the opportunity to exit at extreme euphoria. The market does not overextend dramatically. Instead, it tightens. It builds pressure internally. Consider the industrial base alone. Solar infrastructure continues expanding. Electrification policies are accelerating grid upgrades. Data infrastructure is multiplying globally. Emerging economies are modernizing. Even if silver intensity per unit declines marginally due to efficiency improvements, overall deployment growth can offset that reduction. Lower cost per panel does not eliminate demand, it often increases scale. Now, layer sovereign behavior onto that. If one major nation decides silver is strategic enough to accumulate meaningfully, others will reassess. No government wants to discover that a critical input is scarce only after supply chains tighten. Strategic accumulation is rarely announced loudly in advance. It is often executed quietly and steadily. Even a 50 million ounce program spread over a few years represents material incremental demand in a market already operating near deficit conditions. If compressed into shorter time frames, it amplifies the effect. And then there is institutional capital. Retirement allocations represent a different category of demand. This is systematic capital. It does not chase momentum. It does not liquidate on sharp pullbacks. It flows in on payroll cycles. Week after week, month after month, year after year. Even small percentage allocations across large pools of capital compound into serious physical absorption over time. This is how structural bull markets differ from speculative spikes. Speculative spikes are loud. Structural shifts are quiet, until they are not. The correction after the 2025 surge demonstrated something important. The market was capable of violent repricing in both directions. A 140% move up followed by a 30% crash is not abnormal in commodities. It is cleansing, it removes leverage, it resets positioning. But the deeper question is whether the foundation remains intact after the correction. In 1980, once leverage collapsed, demand was insufficient to support elevated prices. The bull market ended. Industrial demand at that time was a much smaller share of total usage. The global economy was less electrically intensive. Silver was less embedded in technology. Today, industrial consumption forms the core of demand. The market is larger. Production is roughly double what it was decades ago, and deficits are measured in hundreds of millions of ounces. This does not eliminate volatility. It redefines it. The real risk to the bullish thesis is not a paper-driven correction. Those will always occur. The real risk would be a dramatic technological breakthrough that meaningfully reduces silver usage across major industries without triggering equivalent volume expansion. If a substitute material achieved near identical conductivity, durability, and cost efficiency, structural demand assumptions would have to be recalibrated. But technological transitions are rarely instantaneous. Industrial systems do not retool overnight. Supply chains take years to adapt, and even cost reduction breakthroughs often expand total deployment, offsetting per-unit material reductions. Meanwhile, the paper market continues to operate on confidence. As long as participants believe physical supply is accessible at quoted prices, the system functions. But if physical tightness intensifies through sovereign buying, industrial offtake agreements, retirement allocation, and ongoing deficits, the margin narrows. And again, markets move at the margin. When the marginal ounce becomes harder to source, price does not gradually drift. It re-rates. The shift from paper-dominated price discovery to physically constrained price discovery does not happen in one announcement. It happens in stages, inventory drawdowns, premium expansions, delivery delays, increased backwardation, rising lease rates. Each is a signal. None alone proves systemic stress. Together they tell a story. The next major move in silver may not be a repeat of a sudden parabolic explosion. It may be something more controlled, more durable, a steady stair-step pattern higher, interrupted by corrections that reset sentiment but fail to break structure. That kind of move is harder to trade emotionally. It does not provide dramatic entry points. It demands patience. But it builds something far more powerful than hype: conviction. If strategic stockpiling reemerges, if industrial demand remains persistent, if retirement capital continues allocating, and if above-ground inventories remain constrained, the structural case strengthens. Silver does not need mania to rise. It only needs consistent physical absorption exceeding consistent supply. And in a market already running deficits, even modest additional demand can tilt the balance. That is the quiet shift unfolding. Not headlines, not hype, just ounces leaving the system. In the end, this is not a story about a single policy decision or a single price spike. It is about control, control of critical resources, control of price discovery, and control of financial insurance in an increasingly unstable world. If 50 to 100 million ounces are quietly removed from circulation through strategic accumulation, the impact will not be measured in press releases, but in tightening supply and shifting power from paper promises to physical reality. The real question is not whether silver will remain volatile. It always will. The real question is whether the next phase belongs to leverage or to scarcity.